Welcome to Nova Talk. In this first episode, we're asking a simple question about XRP, and we're doing it without the hype. Before we get into it, this is not financial advice. Crypto markets are volatile, and if you hear a claim in this series, you should verify it for yourself before relying on it. A lot of people first meet XRP as a token on an exchange, but the original idea was broader than simple trading. It was designed around a banking problem. How do you move value across borders quickly when different currencies and different institutions are involved? So to understand XRP, it helps to start with cross-border payments, not with price charts. When money moves across borders today, one important network in the story is SWIFT. But SWIFT mostly handles communication between institutions. Put simply, SWIFT moves the message, not the money. The actual settlement happens through bank accounts, correspondent relationships, and balance updates across the institutions involved. That separation is easy to miss, but it's central to the problem XRP was meant to solve. To make cross-border payments work, banks often keep money parked in accounts around the world before any payment even happens. You'll hear the terms Nostro and vostro. In practice, they describe funds held across banking relationships so payments can be settled later. That solves one operational problem, but it creates another. Capital sits idle instead of being used elsewhere, and estimates for that pre-funded capital run into the trillions of dollars, which is why people call it trapped capital. In the legacy model, an international transfer can take anywhere from 1 to 5 business days to fully work its way through the system. Along the way, fees can vary, intermediaries may take a cut, and the final amount can shift once foreign exchange spreads are applied. So the friction isn't just speed. It's uncertainty, complexity, and cost showing up at multiple points in the chain. That's the gap XRP was designed to address, at least in theory. Here's the model in simple terms. Bank A starts with its local currency and converts that value into XRP. That value is then sent across the XRP ledger, with the transfer itself pitched as happening in seconds rather than days. On the other side, Bank B receives the XRP and converts it into the destination currency. In that version of the flow, XRP acts as a temporary bridge asset rather than a long-term holding. If the model works as intended, banks may need less pre-funded capital sitting around the world. Settlement could happen faster, and some ledger costs might come down as well. In the best-case version, that means less trapped capital and a more efficient transfer path overall. That is the pitch. Now we can ask the harder question. A good pitch only matters if people actually use it in the real world. That means looking past the story and into adoption, transaction flow, and where demand really comes from. And once you do that, you run into the deeper questions about whether network usage and token price move together at all. The key distinction to keep in mind is simple. Ripple's software is not the same as owning the XRP token. Those are related ideas, but they are not identical investments, products, or outcomes. In the next episode, we'll map the adoption story in the United States. Thanks for watching Nova Talk.